Hello and welcome to Financial Intelligence. In this video, I want to talk about inflation and how it is a form of hidden indirect taxation. Direct income tax is the most obvious way the government can impose taxes. Since almost everybody dislikes these types of taxes, governments have invented more indirect ways of collecting taxes. Creating inflation is the preferred choice by governments around the world. Legislators know that imposing taxes on the public is political suicide, so they will keep encouraging the Federal Reserve to print money, thereby devaluing our currency and letting inflation do the dirty work for them. The bottom line is that by creating inflation, politicians indirectly impose taxes on the population, particularly on salaried employees. Note that the members of the Board of Governors of the Federal Reserve System are not elected officials. Therefore, their decision to increase the money supply and to cause inflation can be characterized as taxation without representation. If you like the type of content that I provide on this channel, consider subscribing to this channel and also hit the like button and the notification bell so that you don't miss any of my future videos. In this video, I'm going to talk about how the government increases the money supply and how the excess money supply lowers the purchasing power of the currency and how it is in fact an indirect form of taxation on salaried employees. Part 1. Increasing money supply. The Federal Reserve, as America's central bank, is responsible for controlling the money supply of the US dollar. The modern Federal Reserve no longer simply prints physical dollar bills off of a machine. The vast majority of the America's money supply is digitally debited and credited to major banks. In the modern banking system, the central bank creates monetary reserves and sends those to commercial banks. Banks can use these reserves to lend money to businesses and individuals. Technically, banks need to keep only a small fraction of the amount they lend out as a reserve. In other words, in this system, which is called a fractional reserve banking system, the value of new loans can actually far exceed the value of bank reserves. For example, since the legally required reserve ratio is 10% in the United States, with $100 billion in reserves, a bank could potentially issue $1 trillion worth of loans. In summary, the credit markets rather than the printing press for dollar bills have become a funnel for money distribution. The real money creation takes place when the banks loan out to the broader economy those new balances they have received from the Federal Reserve. The fractional reserve banking system allows banks to lend out much more money than they receive in reserves. Part 2. Inflation. Inflation is defined as the decline in the purchasing power of the currency over time. In other words, in an inflationary environment, the purchasing power of the money that you have today is going to be lower next year. This usually happens when the money supply, in other words, the amount of currency available to businesses and people, is increased without a corresponding increase in the volume of products and services available for purchase. It is easier to see how this happens by looking at an example. Consider a very basic economy that produces 100 similar candies and it is supported by a money supply of $100. Under these assumptions, each candy is going to cost $1. Now, if the government decides to increase the money supply to $200 with no change in candy production, each candy is going to cost $2. This example shows that increasing the money supply creates inflation. The result is that the prices are going to go up and the real value of each dollar is going to decline in this economy. Part 3. Inflation is taxation. Inflation is indeed a form of taxation. In order to understand why inflation enables the government to increase the effective tax rate without increasing the federal income tax rate, let's take a look at an example. Consider an extremely simplified economy that consists of only you and the government. You can easily scale this model to include the entire population. Assume that your income before tax is $50,000 per year, shown on the top row in this image. Your income after tax becomes $40,000 per year, assuming a hypothetical 20% direct income tax rate for the sake of this example. In this base scenario, we assume that the government has not printed any money, so the last row, which indicates money printing, is zero. Therefore, in this base case, the government is taking $10,000 from you in the form of direct tax. Now, let's move away from the base case and add inflation created by money printing to this example. In this inflationary environment, the government has decided to expand the monetary supply by 10% by adding an additional $5,000 to the total money supply shown at the bottom row. Since the new dollar is devalued by 10%, I have decided to show the new nominal values in yellow to highlight the difference. In this scenario, you are still making $50,000 nominally in devalued dollars. You are paying $10,000 in direct taxes, and your final after-tax income is still $40,000 on paper. The only difference is that now the government has created $5,000 out of thin air, and it is going to keep it. Now, it would be interesting to convert the nominal values shown in yellow to their real values by taking into account the effect of 10% inflation caused by money printing. The third column shows the real value of yellow numbers in terms of pre-inflation green dollar values. After doing the math, the real value of your income before tax is going to be $45,000, and your total income after tax becomes $36,500. This means that in effect you are making $36,500 in real dollars, although your paycheck shows the nominal value, which is still $40,000. The tax revenue to the government is now $9,000 coming from direct income tax plus $4,500 printed money. The government gets to make $3,500 more in total compared to the base case, and you will earn $3,500 less compared to the base case. The bottom line is that by printing money and creating inflation, the government gets to increase its own revenue at the expense of lowering the real after-tax income of salaried employees. Well, people might argue that in the inflationary environment, nominal salaries also grow. That argument is only partially true. In most cases, inflation will be much higher than the income growth rate of salaried employees, resulting in lowering their real income levels. I hope that you liked this video. If you have any suggestion or recommendation, please add them in the comment section below. Don't forget to like this video and also subscribe to this channel and hit the notification bell so that you don't miss any of my future videos. Take care and thank you.